Hi everybody, this is the third video in my series on lesser accounting as per IFRS 16 or IND AS 116. In my previous videos, I covered the concept of financial lease as well as solved an example of accounting of a financial lease by a manufacturer or dealer lessor. In this video also, I will be solving an example, but the lessor will not be a manufacturer or lessor. Hi, I'm Ranjini. Through my videos, I try to simplify complex accounting topics to help you understand them better. First, let's do a quick recap of the accounting entries to be passed. So, we are talking about a lessor other than a manufacturer or dealer. The recognition and measurement is far simpler than a manufacturer leader. They recognize the net investment in the lease. They de-recognize the carrying value of the leased asset, and the difference is directly taken to the P&L account. The complication comes in the initial direct cost. The initial direct cost is not expensed out. Instead, it is included in the net investment in lease. Now, this is where I did not find an example of accounting for initial direct cost by a lessor in any of my sources. So, I have solved it in the example on the basis of my own understanding. If you have a different point of view, please put it in the comments section below. I am open and I'm really curious to see what are the different points of view regarding this. Also, a disclaimer: before using my method in either real life or in your examination questions, please consult your chartered accountant or your accounts teacher. Okay, so the subsequent measurement, the lease payment that will be received from the lessee is divided not into two parts but into three parts. The first part is interest. The interest is reduced by initial direct cost amortized, and the balancing figure goes into the net investment in lease. Alright, so let's go and solve an example. Mr. H leases a car to ply as a taxi from Mr. D for 5 years. The car is not specialized and is expected to have other uses for Mr. D after the lease term. At the commencement of the lease, the car's fair value is $100,000, carrying amount is $80,000, and there's a balance economic life of 11 years. Mr. D incurs an initial direct cost of $5,000 relating to the lease. The estimated residual value of the car at the end of 5 years is $50,000, of which Mr. H guarantees $40,000. The implicit rate of interest is 4%. Mr. H pays Mr. D $14,400 every year at the end of the year. Mr. H also agrees to pay 10% of the cab fare that he earns in each year. Cab fare earned in year 1 is 50,000 and year 2 is 78,000. Mr. H does not have the option to extend the lease or purchase the car at the end of the lease term. Assuming that Mr. D is not a manufacturer or dealer, what are the accounting entries that will be passed in the first 2 years of the books of Mr. D as per IFRS 16? So you see that this question is identical to the earlier example we discussed, with the only exception that Mr. D is not a manufacturer or dealer. Let us do a summary. It helps us to understand the question even further. Lease term is 5 years. At the commencement of the lease, the car's fair value is 100,000. The carrying value 80,000. Economic life is 11 years. There is an initial direct cost of $5,000. The guaranteed residual value is 40,000. Unguaranteed residual value is 10,000. Implicit rate of interest is 4%. The lease rental is 14,400. There's also a variable lease rent based on usage, 10%. So in this case also the solution is journal entries, working notes. Working note 1, we need to identify if this is a finance lease or an operating lease. Let us go through the more obvious conditions. We know that the lease term is only 5 years out of an economic life of 11 years, which means the lease term is not substantially covering the economic life. The car is not specialized in nature. We know that he doesn't have an option to extend the lease term nor an option to purchase the car. So all of these are indicators of an operating lease. But let's look at that final condition, whether the present value of the lease rentals would cover substantially the price of this asset. For 5 years, there's a lease rental of 14,400. Yes, 4.4514. Now I have explained this calculation in detail in another video of mine titled How to Calculate the Present Value. I'm giving the link here as well as in my descriptions. If you do not understand the step, please refer to that video. The discounted cash flow, 64,100. In the fifth year, the lessee will pay a guaranteed residual value of 40,000. The discounting factor is 0.8218. So the present value of lease payments that the lessee will pay is 96,972. This is around 96% or 97% of the fair value. So it does cover substantially the fair value, making this lease a finance lease. So if it is a finance lease, what gets debited is the net investment in lease. Working note 2 is net investment in lease. We know that net investment in lease is a present value of the lease payments receivable from the lessee plus the unguaranteed residual value. We already have the present value of lease payments receivable from the lessee here. So let's copy that there. To this, we need to add the unguaranteed residual value, 10,000. Discounting factor remains the same, 8218. Net investment in lease is 105,190. This is what gets debited. What gets credited is the carrying value, and the difference goes to P&L account. The entry that gets passed is net investment in lease, debit to car on lease, debit 105,190, credit 80,000. The profit on lease, that's the difference, and it gets directly taken to the profit and loss account at the end of the year. Now here we also incur initial direct cost. Account debit to bank account 5,000. Alright, so now what we had learned is that we should not add the initial direct cost separately to the net investment in lease because it is automatically included in the net investment in lease by adjusting the rate of interest. Right now, the exam question automatically gives me what is the annual lease rental that the lessee pays me. But how do I, as the lessor, identify this amount? This amount of 14,400. How did I arrive at that amount? Right? So let me show that to you by using a working note. This will not be asked in the exam. I'm doing it purely for your understanding. Calculation of the annual lease rental. In year 0, at the beginning of the year, the fair value of my asset is 100,000. Discounting factor is 1. In that year, I have also incurred an initial direct cost of 5,000. Again, my discounting factor is 1. Now I want to know how much should I expect the lessee to pay me every year so that I can recoup this amount. Alright, we do know that in the last year, we will get the guaranteed residual value of 40,000 from the lessee. And I also know that although unguaranteed, there is some more residual value which I cannot claim from the lessee. So that unguaranteed residual value I remove from here. And now I come to what should my annual rental be. I do know that the annuity factor is 4.4514. And I also know what this amount should be. How do I know? I want the sum total of this to be 0. I want to get exactly the fair value plus initial direct cost. So this value is the sum of this whole. So this is what I need to get. I need to get 63,910. And therefore, this value is 60,910 divided by 4.4514, which is 14,357, rounded off to 14,400. So you see, when the lessor calculates the annual lease rental, he already takes into consideration the initial direct cost, which is why the accounting standard says that the initial direct cost is already included in the net investment in lease. Like I said, this working note is not to be done by you in the exam. This is purely for your understanding only. We continue with the usual working note. We know that the repayment that is received goes into interest and repayment of the principal amount. But in case of a regular lessor, the accounting standard says that the interest should be reduced to the amount of the initial direct cost amortized. Let us see how do we amortize the initial direct cost. Repayment relating to initial direct cost. The year is 1 to 5. We are getting, this is the repayment of IDC. So it is an inflow. We know that this annuity factor is 4.4514 and we want it, the discounted cash flow, to be equal to the initial direct cost of 5,000. So every year $1123 of the repayment is to be taken towards amortization of the initial direct cost. Now we come after this to our usual working note of calculation of interest. So it's the year, opening balance, interest plus IDC, the repayment and the closing balance. Now over here, let me do interest net of IDC so that it becomes easy for us to pass our accounting entries. Right, so we have the opening balance of net investment in lease is 105,190. The interest plus IDC is 4%. The repayment is 14,400. Now, what is interest net of IDC? This is the interest, and the IDC that we need is 1123 every year. So this would be reduced interest amount. The closing balance becomes the opening balance. As you can see, the closing balance is the total residual value. End of year 1, we receive a lease repayment equal to the annual rental of 14,400 plus, if you remember, 10% of the cab fare of year 1. All this cab fare portion is considered as variable lease rental based on usage and not based on an index. Therefore, it will not be taken into consideration in any of our entries passed at the time of inception. We do record the payment received and it will be put in as other income. Right. So bank account is 14,400 plus 5,000, 19,400. Out of this, we are getting an interest. If we go into the working note, the amount is 3085. We need to amortize the initial direct cost, and that is 1123. We are earning the variable income that is based on usage is 5,000. So it is the balance that goes into net investment in these. 10,192. Okay, let's see what all goes into the P&L account. The interest, other income from lease 3084, 5,000. There is also, if you remember, a profit on lease of 25,190. So 33,274. End of year 2, we receive 14,400 plus 10% of year 2's cab fare of 78,000, which is 7,800. Part of it goes to interest, part of it to IDC, part of it to income from lease, and the remaining to net investment in lease. The interest we pick up from here, the IDC from here, other income is 7,800, and the balancing figure of 10,600. What all goes to the P&L account? You have interest, other income from lease to P&L. Interest is 2676. Other income is 7,800. PML 10,477. So we've come to the end of the video. I know it has been slightly long and I'm sorry for that. But I hope you have understood what are the accounting entries that a lessor needs to pass. Please note that in your exam, most probably there'll be nothing relating to initial direct cost, making it a lot more simpler than what I have shown you here. Once again, the accounting on initial direct cost is purely based on my understanding of the accounting standard. If any of you have a different point of view, please put it in the comments. I am so willing to learn. I welcome any comment, any suggestion for improvement, or any queries that you may have. I hope you found this video helpful. Bye.